Hello and welcome to another episode of Table Talk. Today, my guest is Wu, a consultant from IG Wealth Management. Today, we're going to look at finance and investing at different stages in life. So, what you need to look at when you're in your 20s, in your 40s, in your 50s, and in retirement. So, Wu, welcome to Table Talk.
Hey, thanks, Emo. Thank you for having me.
You're welcome. Now, Wu, before we go in, could you just give us a little bit of your background and just where you've come from and how long you've been in finance, and just a little bit so people know a little bit more about you.
I came to Canada in 2006. So I came here for high school and went to SMU for university. And then I studied finance and marketing. And after I graduated, I went to a local firm that is doing hedge fund accounting.
Right.
So I was there for 4 years, and then when I was there, I started I got introduced to like a lot of different investment strategy that's I never heard of and never studied at school, and then I become really interested in knowing more about like how the design and how the portfolio management process work. So then I talked to a couple of friends there, and then one of my friends told me to study the Chartered Financial Analyst program, the CFA program. So as I studying the program, I realized I need practical experience as well. So what that means, you have to work at a firm that actually counts your work experience towards the designations. So at the time, I realized the firm, what I did at the firm, although it's really closely related to investments, but it's more on the accounting side. So I started looking for other opportunities in the province, and eventually I was fortunate enough to land a job in one of the big wealth management firms in Canada. So and then also happened to work under another CFA holders. So while I was there, I learn from him about how to look at investments, how to do discretionary portfolio management, and then when I was there, I actually get introduced into financial planning. So at the time when I when I started, I couldn't tell anything different from our RSP, a TFSA, and what is a RESP. But as I working with the people there, and then so then I started knowing all the different tools that will, can actually, like besides investment, that those tools and can also add a lot of value. But then I didn't, and then I just realized not a lot of people know about it. When you work with a typical asset management firms, you have a certain level of asset requirements, and then I realized that requirement actually cut off a lot of people that should be benefit to what I can offer. So then I started looking in a role where I can actually push my my service into a broader audience, and then that's what brings me to IG Wealth Management today.
So when you talk about the different cutoffs, you mean like some places that say you have to have an account that say, $250,000 or $500,000? Is that the kind of threshold you're talking about?
Yeah. So like a threshold that they then you start to benefit from the service. But I just realized, like someone like me, when I was younger, I have all those cash sitting around, but I didn't know how to utilize all the different accounts. And then actually when you at that point when you know how to utilize all those different accounts, that actually give you a lot of bang of your butt. And so then I was always looking for a way that I want to push the knowledge out to more people, and then I followed the financial literacy really closely, reading up a lot of material about the things in Canada, and I realized there's a need, and then my goal is just really just like help out as much as I can.
Excellent. Well, that's good. I mean, and that's basically what we're trying to do, is just to show people what's out there and give them some more information so they have better education to make better decisions. Now, so I think what I'm going to do today is I've had a number of questions that people have asked me over a couple of sessions I've done or workshops I've done. So I have listed about 8 to 10 of them here. And so maybe what we'll do is we just go one by one in no particular order. But
Okay.
before I start asking the questions, maybe I would ask you, what's your take of the importance of sound financial planning, especially at a young age?
Well, I think financial planning, what I do with my clients, is essentially about setting goals and then getting them motivated to take the first steps.
Right.
So the approach typically involves sitting down with them and then ask, so what do you want to do in life? Like, what do you want to achieve? And then they will tell you, oh, I want to retire at this age, or they want to actually do something, build a business, and then saving towards it. So with those goals in mind, and then what we do is we do like something like a reverse engineering. So then I say, okay, so this thing need to happen at this time, and then we first quantify how much we would need for those goals. And then so we set the amount, and then we ask, then we work out the budgets and then see how much they can save, and then what type of investor they are. Are they a risky type, or are they like a conservative type? So we help them build a customized portfolio that fits their personality, and then help them and then build out like detailed steps, like how much you can contribute, and then what portfolio you choose, and then with the given time that's the probability that you can get there. So then we will present the plan, and then over time we also continue work with them to make sure they stay on track. So that's why I think that so I also read a little book about motivations, and then I think what financial plan is actually just help people visualize their goals. So then once they visualize, they can see it, and then they become more motivated. So that's I think what why I would like to push like financial planning to people, just help them get motivated. And then another thing people often don't realize is time. Time is actually in all the plans I do for the client, the more time you have, the chances that you get to where you want to be is the highest. So time is a really valuable asset that people didn't think about very much. So then I think what I like to do just find a way to encourage them to start planning early, and then take advantage of the time that they have.
So yes, you can start. It's best to start early, but you can also start wherever you are today, so to speak.
Yeah. So essentially, once you have an idea, and then you can actually sit down and then like started putting on a drawing board or whatever, and then we just okay, then we just and then we fill out the detail, and then I build out a plan, and then I think sometimes people just feel like things that like 10, 20 years away, they were like, oh, that's so far away. A lot of things change. Yes, but then if you know where you're going, and then it's like when you're driving, you put on a GPS, you say you're going to be an hour. Halfway through, there's a construction on the 102 or something, and then it's like, okay, yeah, then delays, and then you work out, and then you just build a plan from there again. Just see how you can get there. But it's really important to, I think, is know where you're going, and then plan accordingly, and then take advantage of the time. And then I think it's just like really valuable.
So now that's great. I'm going to start asking you the questions now. So the first question I have here was, how should they structure paying off debt versus investing versus saving? So I think this is something, I don't know if you want to look at for the 20-year-old, for the 30-year-old, or for the retired person. I'll let you answer whichever way you feel best.
I think this one, the approach is pretty much the same. And the one thing that I often, one of the guys that I met before actually helped me a lot to put it this way, is to understand the concept of opportunity cost. So which just means that what we can expect from our money in other alternative use. So yeah, I can have 100,000, like I have $1,000 between paying off my debt and investing or saving. So it's always back to the evaluation of which decision will give me the highest bang on my buck. So and then that's how you can maximize you get the money working for you. But essentially, it's same for every life stage. Paying off high interest debt, such like the credit card debt, because they can go from, some product can be as low as 12%, but some of them can be as high as 21, 22%. Sure. So paying them off is always a really good use of your money, because you can think about doing that is giving yourself about a 12% and higher return guarantee. And and then because if you're looking a lot of investments, even like the stock markets and stuff, in long run, very little chance those investment can give you like a double-digit return in the long run. So then paying off your high interest debt is the best use. And then once you finish that, and then another thing it's always recommend people to do is save about 3 to 6 months of your expenses. So everybody's lifestyle is different. So then I couldn't really give an exact amount. So, and then also when you're different age, that would be different. When you're younger, and then you're single, and then your life expenses is probably lower. And then when you have a kid, have a wife, and then but then the general sense is 3 to 6 months. So then those two are really simple but really practical. The harder one, sometimes it get a little bit trickier, is when you get into paying off a low interest debt versus investing, because like sometimes once where you get to when the bank started offering you a line of credit for like 5 to 6%, and then you'd be like, okay, should I pay off the 5 or 6%, or should I invest in the stock market? And then that get a little bit trickier. And then but sometimes one of the common things that I think will happen to people is they instead of paying off debt, they to put into risky investments, and then what happened is they overcommit themselves. They put more than they should otherwise have into those investments, and then in the process they jeopardize their financial well-being. The reason that happen is because there's some behavioral biases like the recency bias, and then the overconfidence, because we normally associate our memory to things that we read the most recent, and then because how available financial news are these days, and then people feel like they have more control, and then that where sometimes investment might have a 50% chance of doubling your money, but also a 50% chance of losing all your money. And by probabilistic calculation, the expected return on the use of that money is actually 0%. But then sometimes people really focus on the doubling the money, and then because they read in the news, they think, oh, this is gonna happen. They misjudge the probability of the investments actually realizing the positive return, and then they committed too much of their money, and they ended up having like affect them in a negative way. Back to what happened, I think sometimes that's why I think financial planning again is a really important piece, because in design, when I work with people in designing plan, then it normally come down to, okay, if we stay in this style for like 5 or 6% a year for the next 20 years, then you will be able to get to where you want to be with a high degree of certainty. And then sometimes when people know that, then they will be like, okay, if I only have to do this, then I don't really have to like get into those things that don't really make sense. And then the problem with other guys is when they don't have a plan, that's when they most likely be tempted by the higher return. So I think that's why I feel like the financial plan is a good way to help them find out like how to use their money properly.
So they have a plan to work with, as opposed to just
so then we always like it's often that by regulations it's like at minimum we review the plan once a year, and then often if something happened to somebody, and then we will review those more frequently. So as the plan change, we always upgrade, we always update the data, and then also find out what is the best, what's the return can still help people achieve those goals. So once you know how fast you need to go, then you don't, then you will stop worrying about, okay, stop worrying about like taking too much risk. And then so then I think that that's helpful. And then in other way, sometimes other extreme cases is people being awfully conservative. So where they if they want to do something they want to achieve, they need to have something that give them 5 to 6%, but then sometimes they feel intimidated by the financial market, and then they stay with something that only give them like 2 or 3%, but then because it's principal protected or something like that, that give them a sense of safety. But then what happening is they actually being farther and farther away from their goals because their portfolio underperformed compared to what they want to be. So a financial plan is really a good way to like help people make a reasonable decision to see like where I should put my money.
So I think what I've taken away from the first one, which was when you had to pick between debt versus investing versus saving, well, first of all is you look at return. So if you have a high credit card that's 21% versus you getting 1% from the bank in savings or less than 10% from investing, you better off paying up for that.
Yes. And then, but at the end of the day, I just know that everyone's psychology is differently. So then what I like to, I want to work with people and then just help them understand. So this is the consequences. And then at the end of the day, it'll be like, you have to be able to sleep well with your decisions, because like some people will invest in something that's really volatile, and then they become really obsessed with the market, and then they keep checking their stocks all day, and then they wasn't able to concentrate because if the stock moving the other way, and then they started getting worried. But then so then my thing is like you should be able to invest in a stock and then not worry about it, because the even though the worst case scenario not going to hurt you, or if you think they're going to hurt you, then you probably should reduce your exposure to that type of investment, because I think it's like there's financial well-being is important, but at the end of the day, your mental well-being is important too. So it's like a balance, so they're finding the balance in the two, and then I try to so then that's my approach when I work with people.
The next question: what financial or investment instruments should people have to benefit themselves and their family? And again, this is one which, if you can answer the stages, or if you think it's the same for all the stages, and leave that to you to respond.
Yeah. So I think because of the innovation in the financial industry happening currently, the access and then the cost to get access to stocks, mutual funds, and the electronic traded funds (ETFs) becoming incredibly low, and so that's a really good thing, because before you had to pay a commissions, and then or you had to go to a full service broker paying like a high commissions as well. So now is a lot of firms going into zero commissions and things like that. So then that help people save a lot of upfront costs. So it's good that people can do that now. And then another thing is people should definitely take advantage of all the different registered saving vehicles provided by the Canadian government. So like things like mentioned earlier, the registered saving plans, RSP, and then the tax-free saving account, TFSAs, and then the registered education saving plans, the RESP, and then sometimes for the next unfortunate, the Canadian government also have the registered disability saving plans and things like that that provide different tax benefits and then things that help encourage people to save. So normally I think it's really important based on people's income and people's budget. We work to like find out the best way to maximize, like contribute to all those plans, and then maximize the the probability to have a highest uh, after-tax return. So then looking into the portfolio becoming tax efficient, because one thing that I often see people ask is like, should I contribute to, like, especially for a younger person, should I contribute to a TFSA first, or should I contribute to a RSP first? And then that really come down to their income levels, because and then the expected earning power as well. So one thing, the difference between a RSP and a TFSA is one thing that get advertised a lot when you contribute to a RSP is you get the tax return. you can reduce your taxable income. But then sometimes it might be better if you're in the early stage of your career, and then you're in a low income tax bracket. It might better for you to contribute to your TFSA first. TFSA, what happened to TFSA is the money you put into it, it doesn't get deducted from the tax. But then in the future, when you take them out, it also doesn't get added back to your income tax at the year. So like, for example, you put money in you put $1,000 in 2021, that doesn't come off your taxable income if you put in the TFSA. But in 10 years later, you take the same $1,000 out in 2031, that $1,000 actually also don't get added back to your income tax. And then that's the difference between that and RSP, because if you contribute to RSP, yeah, that $1,000 get taken off from this year's income. But when you take them out in the future, like 10 years later again, let's say, then that same $1,000 can get added back to that year's income. And then especially if you're in, right now, maybe you're in the low 20% tax bracket, but in the future, you're in the 30% tax bracket. And then that money might actually get taxed at 30% instead of 20% today. So then we're really just looking at where you think you were, and then how to maximize those contribution room. And then that's one of the big part, one of the big exercise in financial planning, just how to figure out how to smooth your like, along with the accountants, because we were like, hey, here's a strategy, but run with the accountants.
Right.
So then that's like something that we help people with, given the budgets and how much they can save. In the ideal world, you maximize the best things, you maximize every year, but most of the people, they couldn't really do that, and then we will find a way to like maximize to come up with a contribution plan that can help them maximize all the stuff that they wanted to do. And then things get more complicated when there's down the future, when there's a kid in the role in the picture, and then you start thinking about how to save for education. So in this case, you have the same level. Maybe you make a little bit more now, and then but then now you have more things to save for. So then we will see, okay, well, when you save in the RESP, the Canadian government actually have a grant for most of the middle tax bracket. For most of the people, the first $2,500 they can get 20% government grant. So then if you put $2,500 into the plan for the year, and then you automatically get $500 from the government. So things like that. So then you work out. So here, that's like, and then we'll see how much you want to have. So for us, it's like, I did one from ourselves. So our goal is to figure out how much we want to give our little girl when she goes to university. And then we decided, it would be nice if she had like $10,000, for example. And then it's like, okay, for 4 years, we go to university, and then each year we try to give her $10,000. And then we work the math back, and then eventually we figured out all we really have to do, basically just like put $70 into the RESP, from now until she goes to university, and then we start working with other things. Then how much going to the TFSA, how much going to RSP, and then for us to have a comfortable retirement too. So that's how the approach works. And then back in the day, and then also a paper that I recently read about is that they're talking about something called a target date fund. So a target date fund is a product that basically they change the asset mix, the portfolio asset mix based on how many years people have left to their retirements. So back in the day, we basically, if you're young, you will have most of your investment in equity, and then a little bit in fixed income. But as you get older, and then so the traditional idea is then you're gonna have more fixed income and less equity to reduce the volatility in your portfolio. And so that paper is actually really interesting because it said like that strategy actually didn't help reduce the chances of people not having enough money. So because that strategy is categorized as to maximize return, but then that idea is actually very different from maximize the probability of you having sufficient income to support the things you want to do. That like for example, that paper is focused on retirement. So then the paper is just saying like that actually that strategy didn't help with making sure people having enough retirement income. So that now they're exploring more ideas, really based on people's risk tolerance, and then based on like how much they need. That is actually the asset mix is focused on the person. It's not focused on the age. So it makes a lot of sense to me as well. So when we talk about the investment strategy right now, it's not really based on age anymore. It's really based on like the dynamic of the family.
Here's another question. They ask, what are common financial myths or misinformation that we should be aware of?
There's so many of them lately, just like we have all those meme stocks and then all those Bitcoin stuff that I talk to people about. But I think that there's enough coverage that people pretty much already have the ideas, but one thing that actually talking about, try to help people realize more, given the current housing market situation, is actually about mortgage life insurance. So what a mortgage life insurance in short is a group insurance product that actually protects the lender. So the insurer pay a fixed like premiums for the life of the mortgage, but as your mortgage getting paid off, the death benefit also started getting decreasing. So essentially, just like something happened to you, you just have enough money to pay off your lender, but no one else. That doesn't sound pretty very appealing to me. And then another thing that actually I find out is from my training is like that product is actually employs a practice called post-claim underwriting. So then what happened is like the insurance company take your premium, but they didn't actually do the underwriting to find out whether you actually qualify for the insurance until something happened and you submit the claim. So then they started looking into it, and then there would be a chance that they can still come back to you. We're not paying out the insurance even though we took your premium because you're not qualified. That's pretty scary. And then so the things right now I'm talking to people is actually for a healthy person, a term insurance that match the duration of the mortgage is actually a better choice, because like you're still paying a fixed premium, probably in a comparable cost. But things is when you do the mortgage, you do the underwriting. So then they know you're qualified. So something happened, you definitely, unless you lied about it, you will get paid. And then the benefit doesn't shrink as the mortgage gets smaller. So that means as the mortgage gets smaller, you actually more is towards your family to help them maintain the lifestyle if something happened to you. A lot of people just really couldn't tell the difference between, like, they just think they have a life insurance, but they didn't know the difference. So then that's one thing that why now everybody is saving for house. And then I'm talking to a lot of people that actually started getting the house now. And then I said, okay, so that's when we're doing our insurance analysis section, and then there's a lot of time it came out that oh, okay, they didn't know.
So in this case, mortgage insurance, not good. A better product is to use a term policy to cover the amount that you think you would owe. And so that even at whatever stage you're getting back, the more you have the product, actually enforce, if anything happens, your family gets more.
Yeah. And then another thing is there's a mortgage life insurance, and then there's also a mortgage protection. So the mortgage protection is where you have to get them if you don't have, if you couldn't have over 20% down payment. So then you have to go to one of those companies to get a mortgage protection. So then that is also again, protect the lender. So by any event, if you fail to pay off the mortgage, the lender is safe because they have the insurance. But if you couldn't pay it, then they can still be able to foreclose your home. So a mortgage protection insurance is also different from a mortgage life insurance.
Okay. So, well, yeah, that's one myth, and that's a big one because I think people get surprised. And again, when we talked about the checking to see if you qualify at the end, when as opposed to in the beginning, so they tell you qualify, you don't qualify, so you don't waste your money. So that strike against that anyway.
Yeah, and that was a surprise to me too when I was listening to some of those calls from the firm, and I said, what? You can do that? it just, yeah.
Well, that's what people need to learn, what they need to know, so they can protect themselves.
Yeah.
Now, the fourth question I have here were, what are the characteristics of a good financial planner? What should people be looking out for when they're looking for one? What kind of questions can they ask?
Okay, so for this one, I think if people just start from the ground up, and then I think some of the evidence that they can look for are credentials of the most recognizable one globally, and like not just like CFP, not just in Canada. There's a lot of CFP in the US as well. So it's one of the most recognizable one, and then I'm interested in getting one myself. Why now? I'm not a CFP yet, but I am a chartered financial analyst. So commonly is just short for CFA. So this program is more focused on the investment side. As I mentioned earlier, when I worked at Seco, I really like to find out how to build a portfolio, how portfolio management works. So then from what I gathered, this destination is one of the recognizable ones internationally in the investment industry. One way to look at it, if people open up their investment funds or like a mutual fund or ETFs, and then look at the portfolio managers, a lot of time they will find someone with a CFA designation on it, or if they have access to a institutional research paper on investments, and on the team members, they typically will find someone with the designation as well. But then in the last couple of years, the CFA institutions institute also talked about a lot about wealth management, because they realize that having a financial plan is a really important risk management tool. As I mentioned earlier, when you have a plan, you know what kind of return you need to get to where you are. So in that practice, essentially can help you filter out a lot of nonsense investment idea out there, and then help people stay focused. I started reading a lot of those papers, and then feel like that's the right call. And then that's why I just like also take a step back from just focusing on investment and back to like helping people to build a sound financial plan and a sound portfolio together, because I think that can help. It's really be the person that can help them answer both sides of the questions. What plan do I need, and then what kind of investment, and then I think that's important. And then other than destinations, I think another thing that the soft skills that are important are listening, and they actually care about the clients. The people that inspire me the most from previous firms and at the current firm, that all of them pretty much share the same thing, as that they actually cares about their client. They meet with them, they take really detailed notes, and then once they don't pretend to know everything, but what they do is actually they take notes, they know what you're concerned about, and then they go out their way to find the answers for you. And then because they know how important their job can have an impact of the client's life.
Now the next question that I got have to do with tools or websites. So the question is, can you recommend any tools or website for financial education? And they also ask the same thing for budgeting.
So one of the most important one about financial education is actually, but it's not really entirely focused on finance. It's a book. It's a book that I recommended to everyone. It's called "Thinking Fast and Slow" by Daniel Kahneman. So he's a Nobel Prize winner in economics, and then he's a psychology. So the book is just all about decision making. Financial education to me is really about learning how to make sound financial decisions. And then in his book, he did a lot of experience over his lifetime. So then wrote down like all the little things that him and his partner discovered, and then we started to realize how our brains make decisions, and then how some of the things that can like influence ourselves, and then either in a good way or in a bad way. So when we make decisions, we have to be aware of them, so then we can filter out the noise and then improve the outcome of our decision-making process. Another thing I think is actually really interesting is a couple of weeks ago, I watched a mini series on Netflix called Money Explained. So it's like a five.
That's good.
You watch that too?
I watched
yeah.
that.
So yeah, I think like they have 5 mini episodes. Maybe the one about the student loan and the one about the U.S. retirement system is not very relevant to us because we have a different system in both cases. But the one where they talk about investment scams, where they talk about the credit card debt, and then where they talk about gambling, and then how they mentioned some of the trading platforms in the U.S. that how they decided to resemble like a casino and then encourage people to behave like they're in a casino. So that's really interesting stuff that I think that I can see when I'm working with people as well. And so then I find it quite helpful.
Okay, well, so I think what I'll do is I'll put the name of the Netflix series, and I'll also put the name of the book in the description. And what you can do afterwards, you send that to me, and I'll add that into.
Okay, yeah, I do that. And for what's the second question?
Any tools
budgeting.
Budgeting. Yes.
Yeah. So this is interesting because we started budgeting a few years ago, but mostly my wife did all the heavy lifting. She went through all the blogs and YouTube videos online, and but what we essentially settled down was having our own Excel spreadsheets, and then actually committed to downloading our statements, and then just like putting all the transaction in, and then filling it out. Like this isn't a one size fits all situation because everyone's is different. It was interesting because when I met you the first time, I said, from Ian, and said, oh, so you taught people about budgeting. So what's the tool that you use? And then you told me, I was like, well, it's not the tool per se, it's the process. And I was like, yeah, it makes a lot of sense to me, because essentially that's what we do. We just, the most important thing is like getting the process down.
And then turning the process into a habit.
Yeah. Yeah.
Which leads
Yeah.
me to my next question is, or do you have any more to add about budgeting before I switch to the next one?
Well, no, you mentioned the habit is also really important. I think like we started sharing our experience with our friends and family too, and then there's and give me your Excel spreadsheets and stuff, and then so yeah, sure, we did, and then but then the thing is like what we realized, just they didn't keep track, so then they didn't committed to the process of downloading the statement, actually putting the data in, and then doing like a variant analysis to see, oh, well, we budgeted $100 for entertainment, actually spent $200, and then we budgeted $500 for groceries, and then we actually spent this much. So then they didn't commit to the process to see like to find out like where the money go, and then what worked, what didn't work, and then continue to improve on the process. So one habit I think I think at least my wife did, is we're getting really good at staying on top of the budget and keep updating it. And then one thing that we also learn is to actually treat savings as expenses. It's not like an afterthought. If after this month, after all my spending, I have like $20 left, and then I will save the $20. It's actually the process. Instead of like saving what you have left, is you actually want to prioritize it, treating that as I want to save $100, and then that $100 automatically become expenses instead of afterthought, and then you will make room to fit the $100 in instead of the other way around.
Yeah, so you touched on one of the questions they asked, which are financial habits. You talked about, even when you create a budget, being consistent in entering your data, because if you put good data in, then you can get good analysis at the end. If you put bad data in or incomplete data in, then you have bad analysis on the other end. So, who are there any other financial habits that you can recommend?
Yeah, so then that's like one, and then like you said, the data part too, because like the whole like we do a lot of retirement planning exercise with people, and then basically like we just had to tell people upfront, you have to be honest with the numbers, because like if you tell me you only want to spend this much in your retirement, but you're actually in the habit of spending more, and then if that spending is not accounted for, the consequences would be really bad, because it would be towards the end of their working life, or they might not even be working, and then they because of extra spending will have potential drawdown on their savings, and then they end up using up their retirement much earlier than they thought. Then they will be at a point where they couldn't make up the spending anymore. Be honest with yourself when you do those things, and then nobody is judging you, and then what we do is we just work with the number, we work with this scenario that come back, and then we just say, okay, there's like things we can do, and then like it's always a try and error process when we do that, we do those things. It's like, okay, so if you do this, that's what's gonna happen. Yeah, so really have to be honest about the inputting the data, I think.
Really, it's being honest to yourself is what it is.
Yeah.
So one question I got was, what does it mean to be self-insured? Or just an explanation of the concept of being self-insured, what it means, and who can use it and who can benefit from it, and when can somebody benefit from that?
Okay, so self-insured is just from my study is one of the 4 risk management techniques. So one thing to understand about risk is that you won't be able to eliminate risk, but you can try to minimize it. So when you choose to self-insure, it just means that you choose to bear the full impact of the consequences should something happens. So, and then the other three techniques are risk avoidance, risk transfer, and risk reductions. I would encourage everyone to read up about the risk quadrants. So then it's like a two-dimensional chart. So you have one dimension is the frequency of a risk event, and then the other dimension is the impact of the risk event. So typically, how the decision-making process goes is when a risk event is a high frequent and high impact, you should avoid it. If a risk event is high frequent but low impact, and then you should look to reduce it. And then if it's a low frequent but high impact event, then you should look to transfer it, let someone else to carry it for you. And then the last one is when you have a low risk and a low impact event. That's when you choose to self-insure. So you keep them to yourself because that don't cost you a lot, and then that doesn't hurt you too much. But the problem is people are not necessarily making the informed decisions. So one of the things we normally do after we finish a plan, the next thing we look into is stress testing the financial plan, try to find weaknesses, and then try to assess the impact of things that happen. So one analysis we often do is what happens if the income streams, because we project someone to make this much money for the next 10, 20 years, but what if that stream get interrupted by untimely death or illnesses? Will the family still be able to maintain their lifestyles that they enjoy? What this event typically considers a low frequency but high impact event. So the best thing to do is getting an insurance to protect those type of events. But then a lot of people actually didn't fully see the financial picture if there's something happened to them. That's what the consequences is. So the analysis we do is actually to help them bring up the awareness that that's what it is. But at the end of the day, it's still up to them to make a decision. And then if they decide not to get insurance still, then the action by itself is self-insured, but rather it's a right action or not. There's another thing.
So if, for example, say somebody is, I don't know, 60 years old and they have, their house is paid off, all debts paid off, and they have, $800,000 in the bank. Do they still need life insurance? I guess those are some of the kind of questions. Or would they just say, I have enough to take care of all the things that I need should something happen? My partner would have money from investments and money to pay. So at that point in time, do they still need insurance? Now I know that this is a case by case thing, so you can just give one umbrella of an answer. But I think that's kind of scenario that that's why I'm asking this question. I'm thinking, is there some point where if you get a financial point where you say, look, I have enough to take care of everything, I don't necessarily need.
That's also with that where now self-direct account become more and more dominant in the industry. So one thing that we talk a lot about is the longevity risk, where the people outlive their assets. So 80,000 might be enough, and depends on how much, like what the person's expenses level is. So then we work that out, and then sometimes as you work with the client more and more, you learn about the family more and more. Like, does the family have a tendency to live beyond? Because a lot of program project their life expectancy is around 90 years old, and then does the family have a tendency to live over 100 years old? And if that's the case, and there's a risk there. So what normally things to talk about in this case would be, like, you still have your CPP, you still have the Canadian pension plans, and then you still have the OH security money coming in, but eventually you might run in the risk of running out other financial asset. So one thing that we can look into, if that's a really a concern that really bother the person, one thing we can look into is helping them get annuity. So you can transfer a portion of your annuity into a series of payment until death, and then that provide a cushion to offset the risk. So when we do that, we'll be like, okay, so that's the impact, and then what's gonna happen to your estate and your other goals, and then if that's something they're comfortable with. So and then sometimes it would be like, no, no, and then they say no, they don't want the annuity, and then effectively it becomes their self-insured, their longevity risk again. So it's defined by the action, and then but again, it's really up to the person.
Okay, so does that cover the part on self-insured?
I think so. Yeah.
Excellent.
Yeah.
The last question that they had here was, what financial pitfalls or examples of financial pitfalls that people should be aware about? I know you had mentioned the thing about credit cards. You had mentioned about some tools that might be the wrong tools. Like talked about the mortgage insurance, which are better options than that because it doesn't do it doesn't favor the person who's getting it at all stages of the should something happen. So are there any other financial pitfalls that people should be aware of? Maybe top 2 or 3 that come to mind.
One thing that I'm seeing a lot is just FOMO, fear of missing out.
Yeah.
So just don't, because I have been in the industry for a while now. One thing I always recognize is there's always opportunity, even though it doesn't matter how where maybe the news make those opportunity sounds to be. There's always opportunity somewhere else. So there's no need to FOMO, like no need to just
think you missed out on something because it happened yesterday and you weren't part of it.
Yeah, like because you read something that done really well, and then by the time you actually read the news, it's almost the opportunity too late. So that's no point, just commit yourself to it. So don't FOMO, and then don't risk the money that you can afford to lose. So don't overcommit yourself. That happened a lot is when, like I said earlier, just when they were so occupied with the gain that they've been hearing about, and then it's like, oh, I need to get in. It's like, no, it's actually like there's opportunity elsewhere. Just take a step back and then think through it a little bit more, because it's vicious cycle. Sometimes when you overcommitted yourself, you started losing money, and then what happens? You really want to make up the loss. You really want to make a break even. So what you end up doing is I need to get even more risky so then I can make my losses back. And then when you're doing more risky trade, the chances of you coming out positive is actually even lower. So then you just keep overcommitting in the hope that you're going to just make even. Like, not at this point, it's not even talking about making money, just want to break even. So I see that happen a lot. That's just back to having a plan and then just stick to it. But it's a lot easier said than done. That's why I step into this role, because I think like there's a lot of people need the help, need a coach. I have learned the skill and I have acquired the knowledge, so then I can help people with that.
I think another one that actually comes to mind is just be wary of noise, where you get your news information from, because there's so much, with the way the internet is and the way the web is in social media and all the news and all the talking heads out there. It's very easy for something to be hyped up by people who understand and who know what they're doing there, and they know when they're going to go in and get out, so they could pump, the old pump and dump. Yeah. So I always say be wary, because anyone can come and talk about what happened yesterday and sound like an expert. The true experts are people who could plan for tomorrow, right? Yeah. It's not the person who's analyzing what happened yesterday, right?
Yeah, like sometimes like I would just talk to some of my colleagues when we see an article, someone would just like, if your in this 10 stock in the past years, you be up so much. It's like, well, yeah, I can go through like a whole database, and then I can
And do
find
that,
out
yeah.
all the names that do well. And then the thing is like, yeah, it's really easy when you just like looking backward, and but it's the process really is to help people develop the process and then trust the process, because
Right.
yeah, and then have the knowledge to help them stay with the process.
Hey, well, it looks like I have come to the end of all the questions that I have here. So Wu, well, thank you for giving us all this information. Are there any other things you would like to add as we wrap this up? And again, like I said, in the end, you're going to send me the links of the book and the tools and the Netflix series. And I would add that to the information section of the video when this is posted. So anything else that we could add? I give you the floor to wrap things up here.
I guess like one thing that I forgot to mention is like in all the different tools, when we talk about different tools in people can use in different stage of their life. One thing I became to appreciate more once I get into the industry is actually insurance, not just the term insurance that we discuss again, like versus the mortgage life insurance, just insurance in general. Because for young people, especially when I talk to my friends and stuff, as much as I like to help them, it's just that because in our current life stage, we don't have a lot of financial assets, and then we don't see the need to talk to a professional. But then the most valuable asset at this point is the human capital. So insurance is a great tool to help protect the human capitals. So things like the living benefit, like disability insurance and critical illness insurance. Those things help. It's just that when things happens, they can help you stay financially independent. And then a lot of things, it's just like because there's nobody talk to them at the moment, then there's an area that they always overlook. So I think that's one thing that as now I started doing more planning for other people, and then I realized how important that is. And then even life insurance is one to protect the family, and then also is a great tool for when they get older. It's a great tool for wealth transfer, and then even just funding the estate taxes, and then those things as people also didn't think about. And then it's one of the things that you tell them that, oh, that make a lot of sense, but then it's not like things that they think about right away. It's definitely would benefit from having the conversations.
Okay. Yeah. Now, if people want to reach you to ask questions, can I put your link also to get to you?
Yeah. You have my email. You have my phone number. If they want to know more about me in the background, I also keep us active LinkedIn profiles. So then it's just keys on Wu and then CFA, and then they can look it up.
So I think what I'll do is when we're done with the call, I'll get the proper to get a hold of you. I know the last person who I spoke to just had a link, was a web link to it's almost like a profile page on the company website, and you just have the information there, so people can get all the information from there. And
Yeah.
so maybe we'll talk about that. Good. Well, Wu, thank you very much for taking time today to talk and learn a couple of things. And thank you for sharing. And I would put a way for people to get a hold of you if they have any questions.
Okay. Thank you so much for having me, and really enjoy just spreading the words out there, and hopefully people find it useful. And
Excellent. Well, with this, again, thank you. And for anyone else who wants to see more information like this, don't forget to subscribe to the channel to see more table talk videos on news and information that could help you live a better and more productive life. Thank you very much, and we'll talk to you soon. Take care.